Ladies and gentlemen, welcome to this investment webinar. My name's Paul Heath. I'm the CEO of Koda Capital. And today we're going to have a conversation with our Chief Investment Officer, Brigette Leckie, just to get a sense of how Brigette is feeling about investment markets and a significant theme that exists there today, and also the way we are positioning client portfolios to adjust for this thinking and the way we think the markets are going to play out. A couple of things before we get started. First of all, here at Koda, we think it's really important that we acknowledge the traditional owners of the land on which we live and work. And so for that reason, I would like to pay my respects to the Gadigal people of the Eora Nation and pay respects to their elders past, present and emerging. Brigette, welcome. And there's been a lot going on in investment markets, particularly over the summer, as we've had some adjustments. Now, you've been talking about inflation for quite some time now, but it's here, isn't it? And it's having an impact. So tell us how you're feeling about inflation as a theme and markets generally.
So inflation really did gather momentum late last year. And I think when we look back in 2021, inflation became the dominant theme. And a lot of people may think it's just been US-led, but in reality, it's right across major markets, with the odd exception and the main one there being China. So simply put, virtually every country is above its central bank target bands from an inflation perspective. Initially, we saw the debate circulating as to a lot of the reasons behind the upsurge in inflation was temporary as opposed to permanent. In other words, the pandemic, a lot of lockdown restrictions, supply side chains restrictions, etc., were causing the problem. But I think it's fair to say that the momentum has now become very, very wide, and it's across both the goods and the services sector. And I think as individuals, you're probably finding in your day-to-day life, you are seeing items going up in prices. Now, I know I'm talking about this in terms of the big event, but the problem is inflation is critical because that feeds through into the cost of capital. That feeds through into interest rates. And I think a lot of you have heard me talk about this before, but over the last 30 years, we've been in a disinflationary environment. So that's enabled interest rates to go down. That has underpinned financial markets being able to re-rate a lower cost of capital. You know, companies have done well. Virtually every asset class has done well as a consequence. We're moving away from that. And this is really the first tangible evidence that we are moving into a new investment regime, which I think is going to be multi-yeared.
You and I have both been around long enough to remember when inflation existed in markets. There's a generation of investors who will never have experienced this idea of what's about to happen. So the chart that we've got here really is last year's story, isn't it? So, but what are you thinking about for the year ahead?
Okay, so I'll again focus on inflation, and we'll focus on some other issues as we go later on. So inflation, I think, again, is going to be absolutely dominant this year. We've already seen quite a shift by major central banks in going from we don't need to do anything in terms of inflation is not going to endure to absolutely current policy settings are inappropriate. We need to raise interest rates. And that's why we've seen a sell-off in risk markets, and we've also seen a sell-off in bond markets. So now it's a matter of what sort of scenarios, what is the pathway going to look like as this year evolves? Now, right now, US inflation, I'm just going to use this as really a guide for other markets. US inflation is sitting, this is headline, at 7%. That was for December. The January numbers are out tomorrow night. Those numbers will probably come in at around about 7.3. So we're still going higher. Now, there are some one-offs in there, as we know, and they will start to pull through. And so inflation will go lower as the year does unfold. And part of that is some of the big energy shocks that we've seen, some of the huge supply constraints. We are seeing improvement in terms of like freight costs, particularly going on that all-important route from China through to Los Angeles, so into the US. That is starting to ease. So, and the other part is demand has been very, very strong, partly supported by very, very generous payouts, fiscal policy during periods of pretty harsh lockdowns across the globe. So in terms of where do things end up, As you can see on the slide here, consensus is that US inflation for this year as a whole will come in at 3%. So that assumes a moderating in demand, easing in commodity price pressures, also the congestion across the ports and across the supply chain improve, and some of the tightness in the labour market that we're seeing also recede. So that's the consensus view. Our view is a little bit more jaundiced than that. We think inflation is going to err on the higher side. So our base case is for inflation of 4%. Where we perhaps differ most from consensus, bearing in mind there's a lot of modelling behind this, is actually on the labour market side. The US labour market appears to be at full rates of unemployment. And what we're concerned about here is that you've seen around about 3 million workers, which is roughly just under 2% of the labour force, potential labour force, exit. Now, we don't believe they're coming back. A lot of those workers are either ill from COVID and have not recovered, they've changed their work lifestyle preferences, they're reskilling, they've retired early, they've made a lot of money in recent years, so that there's a lot of different reasons behind that. So we don't think those workers are, by and large, going to come back in the foreseeable future. So that means we're looking at stronger wage pressures. And at the absolute simplest, wages account for roughly 2/3 of inflation. So that's where we differ. Importantly, what you can see there, we've got some other scenarios there which are actually also extremely viable. And you can see there, we could see inflation heading to double digits, in other words, to 10% potentially for this year. In other words, we're already at 7, just over 7 coming into this week. We could see that happening. And the main reason behind that is this tightness in the labour market. It really is a structural phenomenon. It's been called the Great Resignation, and it's occurring right across the globe, with the exception of just a couple of markets that have got different demographical, economic, and political structures. Now, on the other side of it, a moderation or a recession would see you going into the negative. But again, something brutal would have to happen. You'd have to see like another major outbreak of COVID-19, but a strain that doesn't work. It breaks through the current treatments, the vaccines and the other treatments.
Now, central banks have broadly publicised targeted bands for inflation, and clearly these scenarios are above targeted bands. Is that necessarily a problem? And how do you feel they will react to the fact that these numbers are significantly higher than bands?
So first of all, you are seeing a shift in central banks going, they're quite happy to live with inflation, to now saying we need to start tightening, we need to start removing extremely easy policy settings. So that's a mixture of raising interest rates as well as ending what's called quantitative easing, in other words, stopping the printing of money or expanding their balance sheets. In terms of bringing inflation back sharply by very, very aggressive interest rate tightening, we think central banks are actually going to live with and be prepared to accept inflation above target bands. Now, if you look at that chart there, what I'd highlight, we've gone through periods whereby inflation has undershot central bank target bands, particularly since the global financial crisis. So I think they will be prepared to accept going above. And I think what also is critical, what are the reasons behind this? A lot of them can't be fixed by monetary policy. A lot of these problems actually need to be fixed by fiscal and industry problem issues in terms of like the labour market, more investment in infrastructure, finding more oil, getting more truck drivers to actually join the industry and train them up. This is not an interest rate story. And the last point I'd add to you is it's a shift politically. And that is what you are seeing is that central banks aren't as independent from governments as they have been in recent decades. And we've seen that right across the globe, particularly in the US.
Now, that point that you make about the solution isn't entirely interest rates is quite important, isn't it? Because it doesn't mean that you can necessarily assume that interest rates will follow the same steepness of the curve that sits here on inflation. That's the important issue, isn't it?
Absolutely. So don't expect interest rates to just equal inflation. Historically, they have. I don't like using the words this time is different, but I think that that nexus is going to be broken, that correlation is going to be broken down.
And it's not necessarily true to say that inflation itself is bad for markets, is it?
Absolutely not. Indeed, if you go back during the height of the GFC, it was the absolute opposite, whereby you were seeing markets a little bit spooked by the fact we were heading into deflation, which is negative inflation, and going, what on earth does that mean?
We'll talk a little bit about that because I know that you've got a slide a little further in the deck on that. But this chart is interesting, Brigette, because it sort of gives your view of where you think interest rates might be in the US in particular by the end of the year. So tell us a little bit about this one.
So what this slide aims to do is to put tightening action, which you're hearing about in the media, into context. So if you look at where interest rates stand today and go forward, if you assume that you saw 125 basis point interest rate rise in the US each month for the rest of the year, you'd be at 2% official interest rate. Now, that's the average policy rate that we've seen since 2000, but I need to put the inflation into context. And that is, we've got inflation at the moment at 7. Now, historically, when you've had inflation at 7, you've had a policy rate of 7. When you've had what I was alluding to in terms of our base case, inflation at 4, you've had a policy rate of 6. We are not, even if we do print 4%, 5%, 6, or whatever, we are not going to see official interest rates at that level. It's too hard. It's way too hard to get there. You'd have to be seeing 100 basis point rises each month. That would put us into a full-fledged global, I wouldn't even say recession, it would be depression. Central banks aren't going to do that. They've learnt their lessons. I mean, you could argue that they lifted the easing that we had after the GFC too quickly. If anything, they're going to err on the side of accepting more inflation.
And so let's talk then about how markets behave when there is inflation. And this is the chart that we referred to earlier that talks about, this one here, that talks about the way markets traditionally behave when there is inflation around. So tell us about this one.
So what this chart aims to do is to look at the valuation of the S&P 500 during different periods of inflation. And the data goes right back since 1954. What I want you to focus here on is inflation around the 2 to 3% mark. And you can see there, that is where you've got, if you look at the triangle, you've got average valuations are just under 20% or 20 times in terms of valuations. Putting that into context, valuations right now are just under 24 times. And you can see there, you've got a band there. So we're more or less within that band, which is the lighter sort of rectangular box you can see. Point I want to mention is if you get into deflation, I go to the left-hand side of the diagram, markets don't like that because that's when you've got falling asset prices. You start to see companies really struggle in terms of pricing power. The flip side is when you go to further to the right-hand side, what you can see is markets do not like high rates of inflation. At the extreme right, when you've got greater than 7%, which is really what we're printing now, you can see there, you're looking at high single digits as an average. So that's back to sort of the 70s type environment. Pulling it back to 6 to 7%, you can see there, you're looking at sort of the low teens as being sort of the average. Pulling it more into the environment we're looking at the 4% mark, or if you want to take the consensus of 3, you are looking at PE ratios needing to come back to the mid-teens. And obviously the key question there is, how quickly do we see this valuation adjustment? Is it overnight or is it gradual?
And what's your view on that? Because, you know, everyone's a bit terrified of those short, sharp adjustments, but they're almost impossible to predict, aren't they? You know, so what's your sense of it?
Absolutely. So, I mean, look, I'm getting my crystal ball out here a little bit, but the point on this is as follows. As I just said to you, central banks are unlikely to go really hard and put the world economy into a full-fledged recession. So that's the first point. So that would cause an almighty crash. The most likely scenario, I think, is we have a multi-year grind. So we have valuations just continue to go down and down. It's a bit like we've had a whiff of this realistically starting in November, what I call the high growth or hypersensitive assets, particularly the tech ones, they start to come down in valuations. It hasn't been a huge correction. It's just been like down 10%, pause, may go up 5%, down 10%. I think it's that sort of trajectory as opposed to seeing fall 50%. Now, even if we did have that really nasty scenario, I don't think it's going to be a rerun of what we saw in February, March of 2020, whereby markets had a huge correction, but then almost a bungee jump back. We haven't got the policy stimulus. We've got a very, very different framework. We can't bring the economy back like that. So this is a structural shift to higher inflation and lower growth. And I think it's a 5 to 10 year story.
The other important thing is that whilst the average PE for the S&P 500 is 23.6, just under 24, not every company that is at that level. There are obviously some that are much higher that are more vulnerable to this adjustment, and obviously some which are much lower that actually might benefit a little bit from what's going on. Is that the case too?
Absolutely. And typically those are the higher valuations, if you want to label them. They tend to be the growth stocks, the hyper growth stocks, the ones that tend to have a bit of pizzazz about them. And a lot of names that you've seen, a lot of the ones that have come through, particularly in the new tech areas that's been unfolding, they've come in with very, very high valuations, and they've already seen some adjustment, but they're the ones that are most vulnerable. Then you get the other end, to some extent, these are the boring industrial companies. These are the ones that have been around for 50 years, a lot of cash on their balance sheet, but they're not exciting during periods when markets are going up strongly. A lot of these are cheap, so there are some actual opportunities there. So again, as you rightly articulated, we're talking here about averages, but the devil's going to be in the detail. And that's why we use the word stock picking, finding the actual alpha as opposed to the outright market risk is going to be key in navigating through this environment.
And that thematic you just spoke about, that switch between growth and value, I know that many clients will have read about that because it was prevalent in the press, wasn't it, across the course of January as the beginning of this process was starting to play out. So let's talk about portfolio construction, because as I said at the very top of the webinar, you've been thinking about this for some time and actually been acting on this within the portfolio construction too. So why don't we talk a little bit about the way that we are building resilience to inflation into client portfolios?
So what we've done with portfolios is we've stress tested them, and what we've made sure is that we don't have those areas that are most exposed to inflation. Now, the areas of greatest exposure are the likes of your developed market sovereign bonds. They're most at risk, and then obviously coming through into some of the more vanilla fixed interest area. The other area that obviously is exposed to inflation are these high growth stocks, these stocks that are valued and very, very vulnerable to higher interest rates. And that's why that's already occurring in a lot of these shell type vehicles, these what we call these profitless tech companies. They've fallen significantly. Now we don't have those exposures. So what we've done with the portfolios, if you look across the board, this chart categorizes portfolios really into 3 buckets. The first one is that category called inflation winners. So they're the ones that have got the greatest degree of resilience. The investments or assets that tend to fit into that bucket are the value ones. So they're the ones that got solid models, they've got pricing power, they can actually pass their pipeline costs directly through to the consumer. And as a consequence, they actually tend to do quite well. Commodities also fit in this bucket as well. But again, you've got to be careful commodity by commodity. The other area that we've beefed up and included in recent years, the last 18 months, has been agriculture. And that's why if you look at, you can see there, if you look at our 70-30 Koda portfolio, we've now got 30% weighting to that, what we call inflation resilient, inflation winner bucket. That's up from where we were into June of 2020, and it's up significantly from where we were prior years.
And just for the benefit, why agriculture? What is the nature of the agriculture investments that we've put into the portfolio that respond positively to inflation?
It's outright pricing power. So we've added in fishing rights. And just to give you a feel on that is you've got fixed supply and you've got rising demand as the world consumes more protein. As costs go up in an inflationary world, it goes straight through to the consumer. You and I pay for it. It's as simple as that.
Anybody who has been down to the fishmonger and checked out the price of wild natural barramundi will have seen that in action. It's what's flowing through and linkage through to CPI, isn't it?
Absolutely. And then look more broadly looking at this, if you look at our portfolio, the 70-30, roughly 90% of that portfolio has got resilience to inflation. So in that middle bucket, which we call inflation neutral, that fits the likes of private debt. So that's where we've gained exposure into the defensive part of your portfolio. And then if you move to the inflation losers, we do have a little bit of what I call the growth side, but I'd argue they're quality growth. And a lot of the actual assets underneath that have the ability to be able to move across the spectrum. In other words, put in place shorting of assets so they can actually move depending upon where they find dislocation, where they find opportunities. So when I say we've got 90% of the portfolio really positioned to be able to cope with or rock and roll with inflation, whereas a market portfolio has got a significant degree of vulnerability. You've got about 30-odd%. So we've deliberately done that. I want to emphasize though, when you do look at your portfolio, you are going to see some individual strategies that will underperform for a few months, maybe half a year, even a year. But that's what we want. We want the sort of patchwork quilt type effect. So don't expect green across everything. Those days are gone. And that's because the fundamentals have changed to a higher interest rate environment.
And that's an important principle of portfolio diversification, isn't it, Brigette? Everybody likes a portfolio where everything is going up and nothing is going down. But the problem with that is that means you're not properly diversified. The patchwork quilt, as frustrating as that might sometimes be, is a fundamental principle to capital preservation, isn't it?
Absolutely. And you need genuine diversification.
So let's wrap it up. Rich, you've got a really good commentary there around the emergence of inflation, the prospects for this and what it means for interest rates, the reality that the market will need to adjust somehow to this change of circumstances, and the way that we've built resilience into portfolios to accommodate this. Bring it all home for us in some concluding comments.
So the first point, surprise, is inflation is going to dominate again this year. Expect to see coming through in both central bank rhetoric, expect it to coming through in company reports, ongoing company reporting seasons. Expect that message of we are seeing rising wages, continued pipeline inflationary pressures, supply chain pressures. Expect it to come through. It's not going away. Key is what it's going to settle at. Our assessment is that we're going to see inflation settle above central bank target bands, and they will tolerate it this year, and I think for the next few years. In terms of tightening, don't be scared by tightening. Think about it in the context, we are coming from settings that have been extremely accommodative. So we're moving to some away from emergency policy settings to something that to some extent is more workable. Ultimately, it will give central banks more policy levers going down the track. I don't think they're going to over tighten, because a lot of the problems behind the inflation are not monetary policy related. And I'll just add another point in here, and that is we're in a much more difficult global environment. You know, we've talked about globalization previously. Now we're in what I call deglobalization, where you're seeing people working more on bilateral trade agreements as opposed to multilateral. We've got a lot of frictions coming up. There's a lot of geopolitical risk. The world is not as harmonized as it was. That's not a central bank issue, but it is inflationary. And this sort of taps into my next point, is the other obstacle we've got this year is the election schedule. I mean, we've obviously got our own election here, and this weekend coming up is the first test of this in terms of the 4 by-elections that we've got. But I think the election here is going to result in a change, and don't underestimate what's going to happen with the independent side coming up as well. Then the big one, obviously, is the US midterms, and it's really conceivable that Biden loses both houses. That's going to make it very, very difficult for the US presidency going forward for the next 2 years to get things done. That is not an easy environment at all.
And that also feeds into, Brigette, your point you made earlier about your sense that the central banks are perhaps a little less independent and will probably have more of an eye on the political situation than they might have in the past.
Absolutely, Paul. And it's been apparent by the fact that President Biden has taken so long, one, late last year to reappoint Biden, and secondly, to make appointments for the other 3 vacancies.
So that's for the central.
Yes. For the US Federal Reserve, that's
Yeah.
unprecedented. The appointment process has been so low. We've never seen that before. Normally, it's been very, very quick. So that's already highlighting issues in that respect. So that's the US side. I've mentioned our own. Then we've got Europe. We've got the French elections coming up. And that's not a lay down misère that Macron is going to get through. And obviously, late last year, we had the German election. We've got a new government there. We've got tensions in Europe politically. I haven't even touched on Brexit, let alone the tensions going on between Russia and Ukraine, and in the Middle East as well.
So that all means difficult markets.
Took the words out of my mouth. Absolutely. It does indeed. I think it is going to have a year of ongoing speed bumps, for want of a better description. As I said to you before, I don't think it's going to be an outright collapse, but we are going to have some real ups and downs we have to navigate through. In terms of your portfolios, we've gone through this and we've designed them to cope with, most pivotally, the changing overall macroeconomic environment in terms of this move to systemically higher inflation, and more importantly, a cost of capital. That's your interest rates. And that will enable your portfolio to be able to hold up as well as can be expected in what is going to be a trickier market environment. You know, we've eliminated or removed as much outright market risk, and we've got no exposure to the likes of developed market sovereign bonds. So we've placed these portfolios with this backdrop that we've just spoken about.
And that's a really important issue, Brigette, because as much as we would love your peering into the crystal ball to be flawless, we just don't know. And so the ability to remain fully invested is important, isn't it? Because cash is a terrible option in a high inflation environment, and timing markets is very hard to get that right. That's the philosophy, isn't
it? Absolutely. So in high inflation, cash is going to go significantly backwards. And that's something that most of you won't have seen in your working life. So the cash actually becomes negative. So in terms of trying to think that markets are going to correct, putting numbers at it, for example, like 20%, you're going to cash up in advance. And then when they do, you're going to buy back in, expecting markets then to rebound. The probability of getting that timing right is very, very low. You can probably get stung both ends and get a double negative. So you've got quality assets underlying your portfolio. These assets will be around for the long haul. I mean, some of them are not that exciting. They're solid industrial type assets, but they're quality. So I think sticking with the overall portfolio that you've got, acknowledging that you are going to have months, maybe quarters, even a half year where you will be down, but not down aggressively. I think that's a matter of changing your mindset that we're not going to see the solid returns that you've seen in recent years. You're going to have to accept lower returns in some periods where you are down, but accept the fact and be comforted by you are in a safe set of hands because of the quality of the underlying assets and the genuine differentiation.
Well, Brigette, that was a great summary. Once again, you've done a terrific job of simplifying a very complex set of circumstances in which we operate. Thank you for the work that you and Jason and the ISG team do on behalf of the firm. And we're looking forward to you keeping us informed as the market develops across 22. And thank you very much.